Are Canadians too house poor? Stay tuned to find out exactly whether we are. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Property TV. So glad you joined me here today. Now, today we're going to cover two topics, but one of them is going to be really large. And the main one here is, are we as Canadians really house poor or way too house rich with too much mortgage debt, right? And then the second article that we're going to cover is the pre-com market slowing down and what kind of risk we have. And that one's going to be interesting too. So make sure to stay tuned to the end for that. So the first article that's going to kick us all off is Canadians are house rich but heavily in debt. I will agree with you on that one. And we've been talking a lot about this, and a lot of people are concerned where, when the market is constantly going upwards, having debt looks great because you're essentially shorting the dollar, because today's dollar is going to be worth less than tomorrow because of crazy inflation, despite what all the headlines are talking about. And I tend to agree with that. But what happens in these situations is that our debt is getting way too big for how much income we have. So it's more of a cash flow situation in each family's household that you got to watch out for. And nationally, it's also really bad as well. So it's not just a family level thing, it's also a very much government level thing, right? So the first thing that we're going to talk about, and this is just numbers from StatsCan, right? So I'll show you all the information publicly that's available. But they're saying that Canadians have gotten that much more rich because their wealth has increased from $15.9 trillion with a T to basically, up from 13 to $15 trillion, and that's 20% higher at the end of 2021. Now that is a lot of money, 20% price increase. We saw about 20% to 30% price increase in Canada nationwide. So yeah, kind of lines up. Net worth increase due to real estate values going up, driven by low interest rates, right? So that makes total sense. The scary thing, and this is the part that I want to hammer home, is that the disposable income to amount of debt is 186.2%. Yes, that's the number that I read. Now, that means that for every dollar of disposable income you have, you got $1.86 of debt. So essentially, every dollar you make, you owe about $1.80. Now, disposable income based on StatsCan also includes kind of like rental income, pensions, also investment stuff. It's just any kind of income that's coming in. And it is really freaky. It's really, really bad, right? Now, I'm not saying that every Canadian household is like that, but very much that's kind of what's going for everybody right now. Some people have better balance sheets and some don't. Now, the thing that I want to kind of draw your attention to over here is that this is a chart that was created by StatsCan, and it kind of outlines the percentage of debt of how bad we are relative to income, right? So you can see that even though 186 sounds absolutely ludicrous, going back into over here where it says 1991, that's still 95 cents for every dollar we earn. It's just ever since recently, it's gone up. So you got your little .com bubble, it's gone up. Then you go into 2008, it's gone up. Again, this is asset prices blowing up because, we're in that type of financial repression. Then it continues and it gets really, really bad up to about 2015. That was the massive immigration boom. Interest rates were still really low at the time. And then it gets up to about 184, 85, 6 right here, right? And then the interest rates went up for anyone who's been following the market. So at the end of 2018, the real estate market was very slow. Not many people talk about it because it wasn't like a government intervention, but the rates went up and then the market slowed down. So that we were already there. And then, it was coming down because, Bank of Canada dropped the interest rates. I got more on that in the newsletter. So if you want to check that out, subscribe over here. And then, basically the pandemic came and then the numbers went down because there's more stimulus given out. And then there was less debt because some people were kind of balancing their books so that they don't have as much debt going into what would have been like a pandemic induced recession. And then they decreased interest rates, they increased the amount of money that's in the system. And now we're back at 186.2. So that's to give you an idea of kind of like the history of where we are. And again, this is all derived from Canadian data. So the wild thing when you're kind of looking at this is like, where are you personally on that ladder? And you have to remember, while we look at, for me and myself personally in the investments, our incomes, when we look at investment properties, the cash flow always outweighs the expenses, right? So technically, this is like the debt coverage ratio that a lot of mortgage brokers use. You will always have more income than you should have debt. So you should be under that 100% if you're investing correctly in real estate. However, there's a lot of people who just throw money at the wall, HELOCs to pre-constructions, they close, they're cash flow negative, and that's kind of where your numbers will come down. Strictly talking from a real estate investment perspective. Then there's also a lot of people who take on way too much debt for the amount of income that they're actually, quote unquote reporting. So there's a little bit of like gray area in this data, but at the end of the day, it's still a really, really bad number, okay? And this is exactly why, a lot of people are freaking out because basically this week, I think it's tomorrow. Yeah, tomorrow when this video launches, the day after tomorrow when this video launches, so come on Tuesday, Wednesday, Bank of Canada is going to announce their interest rate hike, if there is one, and it's basically saying right here, 50 basis point or 0.5% is a done deal. We're going to be at 1.5% at that point, right? Now, the thing that I would want to call out to you guys on this one is that a lot of polls are saying that we're going to end the year at 2.25. So that means that from the 1.5 effective tomorrow, right, because this is a done deal, we're going to see another 0.75 increase, which means that we can probably see another one in July, which is what the Bank of Canada is penciling in, and also the Feds, when they came out the Feds minute last week, meaning that there's a very high likelihood of we're getting to 2.25. Now, what that's going to do to the interest rates on the variable side, because Bank of Canada ties into interest rate. And so if you're like prime minus 0.1, just for example, that's a really good rate. Usually like prime minus 0.8. I just went through really bad math on YouTube right now. So effectively, if you're going up to the 1.75, you're probably looking at interest rates of somewhere around 4% right now, right? Which is fine. You're kind of just touching the stress test before things come crashing down. But that's kind of where we are. Bond rate, we saw a little bit of dip in the yield, which meant that the bond rate dropped a little bit, but it's still trending upwards right now. So all the rates on mortgages, whether fixed or variable, are trending up right now. Now, the crazy thing, and this is what I want to point out to you, is that the dangers of hiking into a recession are not lost on the bank, but dampening demand is the only way to slow down inflation. So we've talked a lot about this on the last few months of content. It's, do you kind of increase rates so that inflation is technically going to slow down? But I know, again, by my thinking, you can't drive interest rates and make ports open in China and make China open up and stop a war, right? So I don't think you can do that, but you gotta fight the fight, right? Pun intended, I guess. But at the same time, if you're gonna hike into a recession, because we are, I think we're in one right now, because we already saw a bad one in Q1 and Q2 probably announcing in July. It's going to have a really weird effect on the market, right? So that's kind of why, like, if I was like the head of Bank of Canada, I'd be like, peace, I'm out. I ain't taking this job, because it's like a lose-lose situation, right? So, going back to kind of this article over here, we're saying that the amount of debt we had is really, really high. But relatively speaking, right, we are only 9th in the OECD, right? So you don't have to worry about what that is, but essentially it's a whole bunch of countries and kind of where we rank on the ratings of debt to income, right? So you can see over here, this is a chart from them. The highlighted colors are the G7 countries. So you got like Italy, Germany, US, Japan, and the UK and Canada's right here. We are the highest in the G7 country, but we are not the highest worldwide. I don't know if that's a consolation prize. I have no idea. Depends on how you frame this. So you can see that Norway and Denmark is at 247 and 242 respectively. So I've been there. I think it was a really awesome country and people are really happy there. I don't know if the amount of debt that they have relative to their income makes them more happy or less happy, right? Because based on this, and they're really happy there, more debt makes them happier. But it's one of those things where, like, yes, we're 9th, but you got to look at how the economy is, right? And I do think Canada's positioned very well going into this decade because we have natural resources and we're going to deglobalize, right? So while I think it's very, very high and it's very kind of, what's a good word for it? Like noteworthy in headlines, I wouldn't say that it's the absolute end of the world. And regardless of kind of where, the Canadian family household, disposable income to debt is, you just got to make sure your balance sheet and whatever you're doing when it comes to real estate, specifically like what I talk about, just make sure you're doing it in a proper manner and you account for any kind of like rate hike interest, or you may want to just stress test yourself personally, not the Canadian stress test, or just cap yourself if you're going to purchase, right? So you just have to understand all these macroeconomics to understand how you can make a decision in real estate, right? But again, if you need some help in kind of navigating through this, you can always book a call with me. The link is right here. Now, the thing that I wanted to kind of draw your attention to right here is that as we have gone up in kind of like the disposable income to GDP, right? I want to show you kind of where we were back when we had higher interest rate, because everyone's kind of like talking about where interest rates are and it's the end of the world. It's just like the kind of talking heads, including myself, are talking about, right? So I have here the interactive chart, and this is kind of the overnight rate right now. So for us to get back to kind of like a high amount of interest rate, you can see that we need to get to about May 2008 for 3% rate, right? So they're predicting us, like I was saying earlier, to about 2.25. To get back up to that point, that's kind of where we were in time going backwards, which is more than a decade ago, to get back to quote unquote high interest rates. Because everyone seems to forget, low interest rates are still low. In my books, if you're under 5%, it is still very much low, because you can see over here, it was really high. But the key thing you have to understand is that the amount of debt you had back in the day was not the same, right? So like we're saying right now, every dollar of debt you have, you owe $1.80. Back in 2008, we had about every dollar of debt, you owe $1.50. So by increasing the rates to 3%, call it, right? Increasing it to 2.25, let's just round to 2.5, for example, you're increasing the amount of interest rate by 33%, while we have about another 30% more debt just on the books alone. So that compounded together is a lot of money. And that's kind of why I've been saying, like, at some point, the amount of debt we have when you increase the interest rate, the debt we owe, it's magnified, right? So if you owe $10 and the interest rate is 10%, that's $1. But if you owe $1,000 and the interest rate is 1%, it's still $10, right? That's where we are in the latter. We owe a lot more money and they're trying to increase the rates. So you really have to understand why I say that at some point something's going to break and they're going to have to reset this, because it's either they make everybody learn through austerity and they force a recession, or you take the kind of lazy political pandering way out and you kind of just helicopter money everything out and kind of cover it up and kick the can down the road. Because I don't think that in a 4-window period in which kind of like governments are elected, they're going to be able to tough it out and kind of increase the interest rate and fight inflation. That's just my stance on it, right? That's what you have to understand what's going on to decide what you want to do with your kind of balanced book. Now, the other thing that obviously people have been talking about here is that Canadians want Bank of Canada to press pause amid deep financial worries, obviously, right? And they're saying that a lot of Canadians want interest rates to kind of pause right now. And you have to remember, we came from 0.25 to 1 right now. That's effectively 4 times what interest rate is. Yes, it's a lot, but we were at like 1.25. So we're not even there where we were before the pandemic. The problem that, because it's kind of like, it's not necessarily the best analogy, but I think I stole it from somebody. It's that when you're addicted to cheap credit and easy money and nobody wants to work, you get stuck on that mindset and you start spending like you have more money and you're not fiscally responsible for your own balance sheet, right? So when Canadians are coming out, they're used to just like spending money, having not stimulus checks, serve money, and they're just like kind of going along with it and they don't have to work because their asset keeps going up in price. But when asset goes up in price, their balance sheet comes down, and most of it's real estate, and real estate's coming down nationally now. And then what happens is that people feel less wealthy, and you have a reverse wealth effect, which they spend less. And because of that reason, Canadians want to have interest rates stop. But if they were really serious about fighting inflation, they have to keep going up, and you kind of have to teach Canadians a lesson, right? And that's what I'm saying. Like, just worry about your own balance sheet. Because right now, it's too difficult right now for some Canadians to put food on the table. And I absolutely agree with this kind of message right here. Because on the other side, there was like the K-shaped recovery, and the people who were on the upswing, they also don't want the asset prices to come down. So like overall, Canadians want to come down, but you just have to focus on those who need it. And kind of like in the past, like, call it, 10 years or so, like it's the middle class that's being hollowed out. You're either like at the top or at the bottom. The middle class is just being hollowed out. So it's very difficult for people to kind of make decisions to affect just one type of people or Canadians, I guess. It kind of affects everybody globally. Kind of like how if you affect interest rates, while everyone focuses on the Ontario and the BC market because those are the big markets, when you affect interest rate, you're affecting all the other territories in Canada as well, and provinces, right? So there's another 11 provinces and territories that, everyone in GTA or Vancouver forgets about, right? Now, the last thing that I highlighted here, and this is very important. So in turn, people are trying to spend so much and they're going out eating less, canceling streaming services, driving less, and even changing their diets on grocery bills. And this could be the headwinds ahead of the economy. So we talked about this before, and this is like a Dalio thing where it's like one person's spending is another person's earning. When you stop the economy and you stop the engine, kind of the economy falls down. So actually we're heading towards a recession. So that's why I was saying the central bankers like Bank of Canada, they have a really tough decision to play. Like both sides, it's going to suck. It depends on how you kind of navigate it, right? So it's not very much like a lose-lose situation. You're not really going to win anything, right? And now we got here the next article. Bank of Canada faces credibility test in political firestorm over inflation. So this one I just found very interesting because basically Bank of Canada is being kind of tested like a game of chicken, I've been saying, about whether they're going to increase interest rates, right? And they're saying that there's 3 or 4 more hikes priced in after that, and they're going to stop around 3%. The problem is this is the same guy who said at the start of the pandemic, I think in April 2020, I think April or May, that's saying, hey, we're going to keep interest rates pinned to the floor. Just go spend everything. Stimulate the economy. We're not hiking rates until 2023. It is, by my count right now, June, basically, of 2022. So they are about almost a year ahead of, hiking interest rates. So there's a level of credibility and whether we should trust these people or not, right? And while I have no issue with kind of them pivoting, because I've been saying a lot too, like when you have new data come in, you need to pivot. It's just these guys made a call about inflation being transitory, and they've been so dead wrong that maybe they've lost some credibility. And part of what they do to kind of stimulate and slow down the economy is talk through it out, right? So like when they say something, it affects the market. And for them to fix their credibility, they're going to have to, I guess, make good on their promises of hiking the interest rates. Because if they said they're going to not hike rates until 2023, then they start hiking it. They're like, hey, we're coming after you. We're going to bring this up to 3%. And then they stop hiking at like 2. That's like 2 for 2. Who would ever believe them, right? It's kind of like fool me once, shame on me. Fool me twice, shame on you, right? So I think that's kind of like the situation they're in right now. And it's just very, very weird that like they could have fixed a lot of these things by hiking rates a little bit early, but I think they're just so wrong on the inflation front that it's kind of messed up all of this, right? So that's what they're saying right here, right? Where the Bank of Canada injected way too much stimulus into the economy than what they needed, and they could have just stopped earlier, but they didn't, and they just kept going and going and going. And that's kind of why asset prices are so high, and which is absolutely wild. And that's kind of why I'm making this content for you guys today, to kind of give you an idea of the dilemma I think Bank of Canada has, and why I still think yes, we're going to get rate hikes, but at some point, because of the disposable income to debt ratio, something's going to break, because going from 0.25 to 1, we're feeling it. How are you going to get from 1 to 3? See what I mean, right? So this is the type of content you enjoy. Make sure you help us spread the knowledge by smashing the like button and subscribing to the Prime Property channel, because every single week we make awesome content like this to kind of give you an idea of what's going on. There's going to be a lot of talks about interest rate hike, because this is the first week of June. Then the week after, we're going to have a lot of talks about market watch, and I'm going to give you an idea of what's going to be happening, because this will be another big month of prices dropping. And we'll probably see another big month in July as well, because that's kind of where the underappraisals and the deals falling apart are going to kind of end, right? So make sure you subscribe and click on the little bell notification to see what's going on. And we provide all this data for you guys so they can understand what's going on in the market. Some of our investors are trying to time the market, especially when the bottom is there, maybe start buying. And we provide all this data for you so that you can make an educated decision. And if you really wanted to work with our team and our team of realtors here at Prime Property, you can book a call with me using the link right here. It's www.chatwithzen.com. Now, I'm going to go back to over here, the next article here. Investor interest shows sign of cooling in Toronto pre-construction condo market. Boop, 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 boop. Red flag alert, right? And, the pre-construction market has always kind of like been behind the resale market by a couple months, right? Here and there. And the crazy thing I'm just going to bring out to you is that the cost of a pre-construction in Toronto is at $1,400 a foot. That's ridiculous. That is just absolutely ridiculous. And I'm even thinking of downtown right now. I'm pretty sure there's going to be a project coming out this month by Great Golf and Entertainment District for like $2,200 a month. So again, these prices are getting really, really high, and you got to be worried about it. So when money is not as liquid, even though you're not closing on pre-construction, most people, like I've been saying, their access to how they find these down payments for these pre-cons tend to be line of credit, which we talked about last week. You can check it up here, or refinances. And when interest rates go up, they're less likely to borrow from their house because they don't want to incur that much cost. Because when the gravy train's going and prices only go up, borrowing when interest rates are low, then it makes you look like a genius. But when you don't do it correctly, that's when you kind of get hurt. And people are starting to pull back now because rates are going up, right? So you just gotta watch out for that. Now, the key thing I was going to talk about here is, and I highlight here, is that so when you buy a pre-con for $1,400, which makes it very difficult for investors to cover the monthly mortgage, condo fees, and other housing expenses with rents from tenants, right? And that's kind of the difficult thing. And I showed this chart before, but I'll show it again, right? This is the amount of monthly cash flow you have on this little blue line right here, not factoring the tenant paying down the mortgage. And as interest rates go up, the percentage of your principal you're paying becomes less and less, right? Depending on what mortgage product you have. And this is for a resale condo. So like if you're buying in Toronto, you're averaging maybe like $1,000, $1,100 a foot. So there is that premium of like 20, 25% on pre-con. And if you're already cash flow negative right here, call that $1,000. Imagine if you're buying at $1,400 a foot. You see what I mean? So there's a little bit of a risk there. And that's why I've been staying away from pre-con and telling my clients to watch out unless you're in a specific type of income bracket, right? And when you adjust for tenants paying down the mortgage and you adjust for the mortgage pay down, you're just at zero because the interest rates are going up. So this is the first time it's happened in a very long time. So what happens is when you're buying a condo and your mortgage payment plus your cash flow is less than what you're paying overall, that means you're getting zero returns on your money. To think about that, zero money. So then that means your only way of making money is a speculative one called appreciation. While yes, I have said in the last 42 years, the average rate of appreciation for Toronto properties is about 7%, but that doesn't mean it's going to happen in the future. At the same time, if you're carrying this much negative, you have a hard time carrying it and you have to sell at loss, right? And that's kind of why these numbers are important. So when you go back to the article and you kind of look at these things that are $1,400 a foot, you're going to need rent to like almost increase by 50% by the time this project finishes, and call it 5-year build time, you need 10% a year. I don't think that's happening. I don't. So that's why I'm saying there could very much be like a systemic risk issue right here because things that you're buying at are overvalued. And we talked about the underappraisal video up here. And then when you do come closing on this and you're negative, you probably want to sell. And there's all these tax implications, whether you do assignment, all that stuff. And there's way too many people buying into the assignments. And when you look down here, you can see that the pre-construction space is basically 70% investors, right? So, which makes total sense because like if you're an end user, it's very difficult to buy these products unless you're kind of like having a lot of money and you're trying to downsize from a home to like a pre-construction and you just want the amenities and you're okay to pay a higher price and no stairs and you don't really have a rush to sell your property until the property finishes, right? But if you're a first-time home buyer buying a pre-construction, you have no idea where you're going to be in 5-6 years. You could be married, you could have kids, you could move in a different country, right? So 70% of the pre-construction buyers being investors makes total sense to me. And that's kind of why, like, if a lot of these 70% people who bought are buying overvalued properties, underappraising, and they maybe bought it because they were trying to sign it because, they thought it was a gravy train. Yeah, we're going to be in a huge, huge problem that I've talked about many times before. Like I was saying, 2022, we may have some cancellations for projects because of inflation and the costs going up if you haven't broken ground. Yeah, I think in 2025, 2027, we may run into this issue unless the condo market grows by like 50% in the next 5 years. Which, I don't know, the way this goes, if we slow down for like 2 years, okay, on a good side, and we have to go up in 3 years, you have to go up 50%, that is like 17% a year. Yeah, that's rough. That's rough. That's how I'm calculating my math really quickly, right? So if you are looking at pre-construction, just, buyer beware and make sure you do your homework on what you're buying, right? So hopefully this gives you an idea of kind of what's happening in the market. I know there's a lot going on with the interest rates and the market watch coming up. So make sure you stay tuned to the Prime Properties channel, like and subscribe, as Zhen was saying. But if you are looking to work with us and try to see what options out there right now, if you're trying to buy, sell, and move, like it's not that the market isn't moving. It definitely is moving, but not at the rapid pace we are. And people are always going to need real estate. It's just not at the frenzied amount. So you want to make sure you're working with someone who understands this market, because unless you've had your license for more than like 7 years, you've only been in a seller's market where you're just buying multiple offers and multiple offers. And I've seen many times before where some of the clients we're working with like, hey, we want to make an offer date. And I'm like, well, there's no offer date, right? So, because people have just been conditioned into that manner, right? So you just got to know how to adjust to that times and how to find motivated sellers so you can actually strike a deal. And those are the things that, if you've been in the market long enough, it's kind of where we make our bread and butter, right? And that's what I've always been saying. Like, I actually personally prefer a more slow market instead of a frenzied, fervent one. So we don't have to run around like crazy. So you want to work with us, you can book a call with me using this link right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.